Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Let's start by discussing refinancing, which happens when a company replaces its current debt with new debt that has better terms. This can often be done when market conditions improve, allowing the company to secure lower interest rates or more favorable repayment plans. To understand how refinancing impacts the company, the new debt terms need to be included in the company's financial model. From there, we evaluate how these changes affect key areas like shareholder returns, the company's overall liquidity, and its credit ratios from the lender's perspective. In the images, you can see representations of financial documents, a Bitcoin coin indicating market elements, and a rising graph that suggests positive financial performance, all highlighting the importance of monitoring and modeling these financial changes carefully. The company currently has £12.1 million in senior debt with an interest rate of 12%. Since market rates have dropped, we've chosen to refinance this debt at a lower rate of 8%, which includes an arrangement fee of 0.9%. This refinancing will impact the company's financial outlook, and we've updated our profit and loss, cash flow, and balance sheet forecasts to reflect these new terms. Before refinancing, the company's cash position ranged from a minimum balance of £15.3 million at the end of 2010 to a maximum of £104 million by the end of 2020. Our lenders' credit ratios show strong financial health, with our debt-to-equity ratio staying well below the target maximum of 80%, free cash flow to debt comfortably exceeding the minimum target, debt to EBITDA and debt to net assets ratios also remaining within acceptable ranges, and interest cover far above the minimum required. Overall, these figures demonstrate a solid financial position before we make the switch to more favorable debt terms. We have successfully saved over £2 million in net interest costs across the 5-year facility. This refinancing has strengthened the company's financial position by slightly improving shareholder returns, cash reserves, and interest cover. Looking at the cash position, the minimum balance was £15.3 million at the end of 2010, while the maximum balance reached £131 million by the end of 2020. The lender's credit ratios also show positive outcomes, with key metrics such as the debt-to-equity ratio, free cash flow to debt, debt to EBITDA, and debt to net assets all comfortably within target ranges. Interest cover, an important measure of the company's ability to meet interest payments, has improved significantly with a minimum of 28.4 and an average of 56.3, well above the target minimum of 2. This overall improvement, as referenced in the summary sheet comparing before and after refinancing, clearly indicates the financial health and stability we have achieved through this process. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.